Hello guys, welcome back, and I hope I'm audible to all of you. So we started cost of capital in last session, and we will be continuing with further questions related to cost of capital, and also we will complete our question that we started in the last session. And once we complete this question, we'll move towards another cost of capital question, and we will also attempt one question, past exam question related to sources of finance. So we started cap company question yesterday, and we were done with the cost of equity and cost of debt. But let me quickly go through the cost of capital, cost of equity, and cost of debt, and then we will calculate weighted average cost of capital. So Hamza, I'm going to discuss this on the WhatsApp group later. Let me first continue with this question, and I'll explain the reason why I did it that way. And once we will be doing this Tufa company question, you will get a better idea of why I did this one this way. So let's okay, can you people just tell me the figures that we calculated in previous session about cost of equity first? It was 13%. Okay. Uh, Cost of debt of preference shares, 10%, and cost of debt of loan notes, 5%. Okay. Okay, now I need to calculate weighted average cost of capital. So the format that I'm going to just show you people will be very effective for calculating the weighted average cost of capital. So we have three sources of capital at the moment: the equity, preference shares, and loan notes, right? And their costs were, let me copy these three figures and paste them here, right? Now, we need to calculate the weighted average of all of these different types of costs. But while calculating the average cost of capital, we need weightages. And there are two types of weightages, one based on market value and the other is based on book values. So we have to look at the question, what does the examiner want us to do? Calculate the weighted average cost of capital and use your calculation in answer to requirement A above for the cost of equity and ignore any impact. So we don't have uh, any information of what the examiner is looking for, whether he wants us to solve it using market values or he wants us to use book values. But in that case, we should always use market values. And the reason why it should be used is that whenever you are buying a share as an investor, it will always be available on the market value. So you have to invest as per the market value. Similarly, if you are buying any debt instrument of the company, you will have to buy it at its market value. So the investment will always be on market value and the expectation of return will always be based on the market values. So if you expect the company to give you 13%, that 13% should be of the market value. This is what everybody should expect, because if you are investing as per market value, the return that you will be expecting will be as per market value. So first of all, let's calculate the market value of the equity. The ordinary shares were quoted at 3 per share on 30th December. That's the market price per share. Okay. And we have to multiply it by the number of shares. So par value of the share is $1 and the total share capital is of 200,000. So in order to convert it into number of shares, what we need to do is we have to pick the total value, and I'm picking it into thousands. Excuse me, in thousands, and I can just keep it in millions as well, so it won't make any difference. So 200 and should be divided by this par value, whatever the par value will be. This will give us the total number of shares in issue. 200 divided by 1, so it will be 200. And if I multiply it by 3, I'll get the market value in millions. So better to write million, 600 million. So that's the market value of equity. Similarly, the market value of preference shares will be calculated in the same way. 50, which is the total value, which is the total value, divided by 1 and multiplied by the market price. The market price of preference shares was $0.9. Here we go. $0.9, 45 million. And then for the loan notes, again, we have to pick the total value from the balance sheet, which is 250. And usually the loan note will have a par value of 100. Usually it will be 100. So let's divide it by 100. And the market value of this loan note is 100.57. And that's 2451,425 million. Okay. Now, what we should do, we should first calculate how much we will be paying to our investors. We'll be paying them 13% return, right? And their investment value is 600. So we'll be paying 13% of 600 to our investors for the whole year. equity investors, and it is going to be 78 million. Similarly, to our preference shareholders, we will be paying 10% of their investment value, which is 45 million, 4.5. And to our loan notes investors, we'll be paying 5% of their investment value, which is 2.5. And the total that we will be paying, will be the total of these three, and that's 95.07. And this is the total that we are paying against the total investment of 645, and this. The total investment in our company is equal to 896.425, against which we are paying annual return of 95.07125. Now, in order to convert it into percentage, we have to divide 95 by the total value of investment to get the average cost of capital. That is, what are we paying as a percentage of investment, and that's our weighted average cost of capital, 10.61. That's how we calculate weighted average cost of capital. So the average of these three types of costs will be 10.61. The market value of loan has been calculated by dividing the total book value this by 100 to get the total number of loan notes, and then multiplied by the market value to get the total value of the loan notes, total market value of the loan notes. ACCA, we have adjusted the amount of interest for the tax in the previous session, and we do not need to adjust the market value of any loan note with a tax figure. There is no need to. This figure has already been adjusted for the tax. Colleague, can you just explain your question? Yes, Fareen, they are absolutely okay. Whatever method I am teaching you people will be acceptable. This is not the first time I'm teaching you. This is my sixth P2P session, and I've been teaching F9 for last 13 years. So don't worry, I won't teach you any method that you can't use in the exam. Collie, what was confusing you? Can you just repeat your question? The value of equity? Are you talking about the value of equity? Okay, here we go. Let me repeat it. No issues. The total capital of the company is equal to $200 million, right? That's always reported at par value. So 200 divided by the par value of each share will give us the total number of shares. So first of all, we have to calculate the total number of shares. So 200 divided by 1 will give us the total number of shares. And then we have to multiply these number of shares with the share price prevailing in the market, and that is $3. So we need to multiply it by 3 to get the total market value of the equity, 600. I hope, Collie, It's clear now. Sure, Aisha. Just wait for a while. Let me show the WAC formula for Farheen first. Valentine, yes, it's 5.6, but you haven't divided it by the market value. We should divide it by the market value as well. We should divide 5.6 by the market value as well. And then we are going to get the cost of debt. Okay, now Aisha has requested that I should go with the other formula of WAC as well. So I'm just explaining the other formula as well, right? Okay, in that formula, we need to calculate the proportion of each source of debt. Each source of debt. So I need to calculate percentages, right? So what's the total value of equity? It's 600 out of the total investment of 896.425. So this is 66.93% of the total investment. The total value of equity is 66.93% of the total capital. The total value of preference shares is 45 million, whereas the total value of capital is 896. And if we want to find out what is the percentage, we have to divide with the total, and it is 5.02% of the total capital. And the total value of loan notes is 251 approximately, and the total value of capital is 896, and this is 28%. So if we just add for the sake of our own clarification, it's 100%. So of the total capital invested, 66%, 66.93% is equity, 5.02% is preference shares, and 28.05% is the loan notes, right? So if we need to find out WAC using the proportions or the weightages, then what we can do is we can just pick 13%, which is the cost of equity, and multiply it with the proportion of the equity, 66.93. I just need to multiply it with this percentage, plus 10% multiplied by 5.02 plus 5% multiplied by the ratio of loan notes. And if I add these figures, I'll get approximately the same value as the above value, 10.61. So you can use the value that you can use the method that I used here, and you can also use this method. That's totally up to you. Aisha, did you get it now? Okay, I've already done twice. So for the repetition's sake, I would request you to watch this video once the recording is available, because I have to complete uh, today's topics. Hussein, Just watch the recording once it's available. And in case you find any problem, then just drop me a message on WhatsApp. I'll definitely respond to this. So that is how we calculate weighted average cost of capital. And let me move towards the next question. And Hussein, I will just do the same method again in this next question, and hopefully you will understand it. Tufa company, what are we supposed to do in Tufa company's case? We have to calculate after tax weighted average cost of capital of Tufa company on a market value basis. Here they have mentioned that we have to use market values as our weightages. So for weighted average cost of capital, first we need to calculate different cost of different sources of finance. So first of all, we need to find out the cost of equity, and we need to find out which model we should be using. Uh, the following statement of financial position information relates to a company listed on a large stock market which pays corporation tax at 30%. We have a balance sheet of the company, and then says the share capital of Tufa company consists of 12 million of ordinary shares and 5 million of irredeemable preference shares. The ordinary shares of Tufa company have a nominal value of $0.5 per share and ex-dividend market price of 7.07 per share and a cum dividend market price of 7.52 per share. The dividend for 2007 will be paid in the near future, and dividends paid in recent years have been as follows. So these are the dividends that have been paid in the previous years. And 5% preference shares of Tufa company have a nominal value of 0.5. And okay, so from the question we can easily find out the method that we are going to use for calculating the cost of equity. So it's the dividend valuation model, because all the information mentioned in the question is related to dividend growth model, right? So first of all, for the dividend growth model, we have to calculate growth. So how do we calculate growth? Basically, we need to find out at what rate the dividends have grown from 2003 to 2007. For this, first of all, we need to calculate dividend of 2007 because it's not given, and we must calculate it for the sake of calculating the growth. So the dividend for 2007 will be calculated by taking the difference of the cum div share price and the ex div share price, because the difference between a cum dividend market price and ex dividend market price is the dividend for the year. So the share price with the dividend is 7.52. That is the share price with dividend. And the ex dividend, that is if the dividend is subtracted from the price will be 7.07. So 7.07, and the difference between the two will be the dividend per share for 2007. That's the latest dividend which is supposed to be paid shortly. So that's $0.445. Then we need to pick the earliest dividend given in the question. Which of the years is the earliest? 2003. And we should ignore whatever is in between. In 2003, the dividend was 0.37. This dividend has grown at a certain rate, and has gone up to 0.45 in 2007, right? And if you people remember the formula for compound interest, we will be using the same formula, the compound interest formula, that was S is equal to P into 1 plus R raised to the power N. We should use the same formula for calculating the rate of growth, that is R. The same formula should be used, but we have to place the values correctly. Sum means the future value, right? So which of these two will be considered as the future value of dividend? Which of the two? Yes, 0.45, that's the latest one. So that should be considered as S, the sum, the future value. Which should be considered the present value, that is the earliest value? The 2003's dividend, which is 0.37, right? So I'm just putting it, and then we will be rearranging and using Excel. We will be solving using Excel. So for just your sake, I'm just putting these values here. 0.45 and is equal to 0.37 and 1 plus R is growth here. We need to find out the growth at which this 0.37 has grown to 0.45, and raised to the power the number of years it took for dividend to grow from 0.37 to $0.45. So how many years are in between? So I'll just show you a trick. Never count 2003, because that's the end. We have got this figure at the end of 2003, so we should not count 2003. So we should start counting after 2003. So it should be 2004, 1, 2005, 2, 6, 3, and 7, 4. So it was 4 years. So what we actually want to know is at what growth rate this 0.37 dividend has grown to 0.45 in 4 years time. So let's rearrange this. So I have to divide 0.45 by 0.37, because this has to be divided to the on the other side. 0.45 divided by 0.37. So if I divide it here, I'll be left with 1 plus g raised to the power 4. So to cancel this power, I have to take 1 upon 4 as power on the other side. So on this side, I'll just take a power sign 1 divided by 4. If it's 4 on the other side, I have to take 1 upon 4 on this side. So if I take 1 upon 4 on this side, this 4 will be cancelled out and it will be gone. And I'll be only left with 1 plus g. And this one will also be subtracted on the other side. So I'm just going to subtract 1. And this is how we should be calculating the growth. 5.02%. I don't know from where has this 9.8% growth rate come. It's 5.02%. The dividend has grown at a rate of 5.02% per year to $0.45, and that's the growth rate. So I'm just putting it here. So whatever I did here was just for your explanation and should not be shown to the examiner. So for examiner, that's enough. This formula is enough for the examiner, so you don't need to show it again. So I'm just leaving it for all of you, and I'm moving forward. Now I should use the dividend valuation model or dividend growth model, DGM, which is D naught, that is the current dividend. The current dividend we have already calculated. and it is 0.45. That's a current dividend, 0.45. Okay, it should be multiplied with the 1 plus growth, which is 5.02. Now, just wait for a while. I just need to explain a very important concept where most of the students make mistakes, right? So I want you people to listen carefully. Listen carefully. One important thing that you should note, my experience of 13 years has told me that most of the students in paper F9 fail because of small mistakes and not because of the big mistakes. Most of them fail because of the tiny mistakes that they make, and they don't even realize they have made mistakes. And one of the mistakes is the one that I'm just explaining now. Don't worry, Thomas. I'll just explain. So one of the mistakes that most of the students make is, remember, what's the dividend that we are going to pay in a while or in few days? What's the current dividend that we need, that the company will be paying? 0.45, that's it, right? Okay, okay. Now think like an investor, right? If you are buying a share of a company today and investing today, when are you supposed to be getting your first dividend? Usually 1 year later, right? So your return or your profit or your dividend will always be the one that you are going to get after 1 year and not the one that you are going to get very soon. So that's not the dividend. Your dividend will always be the one that you are getting after 1 year. So are we going to get the same dividend after 1 year? No, right? The return for anyone who will be investing today will be the one that they are going to get after 1 year, and after 1 year we should be getting 5% more than this one. So let's multiply it by 1 plus this growth rate, and that's the next year dividend, and this is what that the new investor is going to get, the next year dividend, the year 1 dividend. Remember, dividend growth model always take this dividend into account. It always take this dividend into account, and it should be taking this dividend into account. So we should always be taking this one into account, but sometimes this dividend is not given in the question. They give us the current dividend. That's why we have to multiply it by 1 plus g in the dividend growth model. The only reason why we multiply it by 1 plus g is to get the next dividend. So what most of the students make a mistake is, when they get year 1 dividend, they still multiply it by 1 plus g, and if they multiply it by 1 plus g, they are actually getting the second year's dividend, which is wrong. They're skipping the first year dividend. So it should always be the year 1 dividend. So if I take this one, I have to multiply it by 1 plus g. Or if I take this one, I don't need to multiply it by 1 plus g. I should straight away pick this one. So make sure you are picking the right dividend in the formula. So for simplicity's sake, I'm just picking up this one. So dividend of year 1 divided by the market price. What's the market price of the share? The current market price of the share, and it should always be X div price. Remember, it should always be X div price. What's the current X div price? 7.07. This is what you are supposed to be investing, and this is what you are supposed to be getting after 1 year. So your usual return, if there is no growth, will be 0.47. But since there is a growth as well, so you should add the growth factor here, and it should be 5.02. And the cost of equity will be 11.7% using the dividend growth model. 11.7%. And if we calculate it without growth, KE without growth, then we can simply take 0.45 and divide it by 7.07. Without growth, it's 6.36%. And with growth, it's 11.7%. That's not required. Is it clear? So let me take you to the growth formula again, because somebody asked about the growth formula. The simple way to calculate the growth was just divide your latest dividend by your earliest dividend first. The latest dividend by your earliest dividend, that's S divided by the P. And then take power 1 upon N. That is the number of years between these 2 years. And subtract 1 from it, and at the end multiply it by 100 to get the percentage sign. This will tell you at what rate the dividend has grown from one figure to another figure after n number of years. 5.02. Now Ifra says that kindly explain why I have added the growth at the end, because the dividend will not stay at this level. It won't stay at $0.47. It will be growing at a 5% rate. So the dividend growth model says that you should add this growth rate into your cost of capital. So just a quick yes or no. Did you people get this calculation? Okay, now move forward. Let's move forward. What are the sources of debts? How many sources of debts do we have? We have preference shares, and we have long-term borrowing of loan notes, right? And a 3 million bank loan as well. So there are three sources of debts. So let us calculate the cost of debt of each of these three one by one. Cost of debt of preference shares. The 5% preference shares of Tufa company have a nominal value of $0.5 per share and ex-dividend market price of $0.31. Okay, and nowhere it's mentioned that it will be redeeming these shares, so we will assume that these are irredeemable shares. And no, they have mentioned it. They have mentioned that these are irredeemable. So even if they haven't mentioned this thing, we should consider them as irredeemable. So we should take this 5% and multiply it by the nominal value. The nominal value is 0.5. Don't forget to do this thing, otherwise you will make a mistake. So multiply it with the nominal value and divide it by the ex-div market price. Ex-div market price of 0.31. 0.31. So it's 8.06%. After cost of debt of preference share, let's calculate the cost of debt of bank loan, which is very easy. The bank loan is the most easiest thing for which we calculate the cost of debt, and that is just what's the loan? What's the interest on loan? The bank loan has a variable interest rate, right? The bank loan has a variable interest rate. So what should we do? They haven't given us the interest rate, I think. The bank loan interest rate hasn't been given to us. So what should we be doing in that case? Should we ignore bank loan, or should we assume this bank loan to be having the same interest rate as the loan notes? Yes. So everybody, remember, if we don't have any interest rate given for the bank loan, then we should pick the loan note interest as the bank loans interest rate, 7%, and we should make it after tax, as it will be, as the interest is always a tax allowable expenditure. So make it as net of tax, 7%, and we should take 70% of this. It should be 0.049 or 4.9%. Now comes the loan notes. The 7% loan notes have a nominal value of $100 per loan note and a market value of 102.34 per loan note. Annual interest has just been paid, and the loan notes are redeemable in 4 years time at a premium to nominal value. After 4 years it will be redeemed, right? Now in the question, Sarah, we don't have interest rate for the bank loan, so we don't have any other rate that should be considered as a bank loans interest rate. We can't take preference shares interest rate as a bank loan interest rate. So a better way will be to take the loan notes interest rate as the bank loans interest. Okay, let's move forward. And now the trickiest, the tricky thing is to calculate the cost of debt of these redeemable loan notes. And I want you people to watch it carefully now. Now for this part, you, for a while, you have to think from the investor's point of view, the one who is going to buy these loan notes. The return of the investor will be the cost of the company. So if we are able to find out the return of the investor, the same will be considered as cost of the company, because the company is the one that will be paying this return, right? So just consider it from investor's point of view. And when investor is calculating its return, it is the IRR. So we have to calculate the IRR of this investment from the investor's point of view. Okay, let's do it the way we calculate IRR. First of all, year and particulars. And cash flow. Okay, tell me, if you are investing and buying these loan notes, at what price you will buy this loan note, and what will be your initial investment for buying a one loan note? So at 0.0, we are going to invest minus 102.34. This is the investment. So this, consider it to be your initial investment, right? And thereafter, every year, what will you receive against this investment? The interest, right? From year 1 to year 4. from year 1 to year 4, right? Market value, that was market value. Now we are talking about interest. So the interest is 7%, right? That's something that you will be receiving, so we should write it as a positive value from the investor's point of view. 7% of par value, and it should be net of tax. So take 7% of the par value to get the annual interest and make it 70% to get it net of tax. So it's $4.9 every year for 4 years. And what will happen after 4 years? After 4 years, we are going to get our money back like scrap value. Like scrap value. Hamza, the tax rate was given at the start of the question. It was given at the start of the question. So we will be getting our money back at a premium of 5% at par value. So the par value was $100 and the premium is 5%. So we will multiply it with 1.05. Now this is just like an investment appraisal question. So all we need to do is to find out the internal rate of return, for which we need 2 rates and 2 NPVs. 2 rates and 2 NPVs. So we have to assume a rate. So let me assume the first rate to be 3%. I've just randomly assumed. And for 3%, we need discount factors and annuity factors. So the discount factor for zero cash flow will always be equal to 1. Here we have to use annuity factor for 4 years. So the formula for annuity factor is 1 minus 1 plus R, which is 3%. I have assumed 3% from my own side, raised to the power minus 4, and whole divided by 3%. 3.7. And here we have to use discount factor because it's a single payment. 1.03 raised to the power minus 4. And then we need to calculate present values at this rate. And that's the positive NPV. And we need a higher rate to get the negative NPV. I'm just assuming 8%. Just assuming 8%. I hope it gets, for year 0 it should be 1. And let me copy paste this formula again. We don't need to write this formula again. We need to just change the rate from 3% to 8%. Okay, mistake. And we have to have 8% here in the denominator as well. This is so we've got a negative NPV, and let's calculate the IRR, which will be the cost of debt. So though I'm calculating IRR from the investor's point of view, but that's the cost of debt for the company. So the lower rate, which is 3%, plus the positive NPV divided by the positive NPV minus the negative NPV multiplied by the higher rate minus the lower rate. So that's the cost of debt of this project. Ashar, what we did in the last session was we did it for just 1 year. Uh, that was for only 1 year. So the debt was going to be redeemed in just 1 year. That was just 1 year calculation. We can't do it here because it is going to be redeemed in 4 years' time. Fareen, from 1 year, from year 1 to year 4, we are getting interest. Therefore, we wrote it separately. And at the end of the 4th year, we are getting a different amount of 104. The discount factor, I just assume 3%. You can assume any other rate. Sanket, it's totally at your discretion. You can choose any other rate. What's wrong with the cost of debt of preference shares formula, AXA? Is there anything wrong with this? Okay, now let's calculate weighted average cost of capital. And we have to first calculate market values, and then we need to calculate the weighted average cost of capital. So we have three sources: equity, we have preference shares, we have bank loan, and we have loan notes. 4 sources of finance. And let's first write cost of each. Just refer it to the already calculated values. And now let's calculate market values. So we have to go to the question to find out the market values. First of all, share capital. The share capital of Tufa company consists of 12 million ordinary shares. And the ex-div market price of each share was 7.07. So 12 million, which means 12,000. Let's write it in thousands, multiplied by 7.07. And let me state that we are getting it in thousands. So that's the market value of equity. Then we should pick up the preference shares. How many preference shares do we have? It has a nominal value of 0.5. Was that 0.5? Okay, sorry. But even if the nominal value is 0.5, we don't care because we have been given Okay, I thought that's the total number of shares. Sorry, my bad. My mistake. I thought it's the number of shares. We have to convert it into number of shares first. So the 12,000 is not the number of shares, it's the value of the shares. So we have to divide it by the nominal value, which is 0.5, to get the total number of shares, and then we should multiply it by 7.07. Thank you, Sheriar. Thank you so much. So 12,000 is the value, nominal value, and divided by 0.5 to get the total number of ordinary shares, and then multiplied with the market price per share to get the total market value of equity, which is 169,680. In the same way, we will be calculating the value of preference shares. The nominal value of the preference shares, the preference shares even has a value of 0.5, and the total value of preference shares will be available in the balance sheet, I guess. No, it will be somewhere in the data. Okay, 5 million. It's 5 million. So we'll repeat the same type of calculation is equal to 5 million. We should write it as 5,000 divided by 0.5 to get the total number of preference shares multiplied by the price per share, which was 0.31. Bank loan. The bank loan will have no market value. It should be the same as its book value, as it's a non-tradable. And here we go. The long-term borrowing consists of 10 million of loaners and 3 million of bank loan. 3 million of bank loan. So 3,000. And now we are here for the loan notes. The loan notes has a par value of 100 and the total value of 10 million. 10 million. So 10 million means 10,000 divided by 100 and multiplied by the market price, which was 102.34. 10234. And let's add all of them to get the total market value. So we have a total value of investment of 186014. That's the total value of capital, or you call it investment. Now, to our equity investors who have invested a total of 169680, we are paying 11.7% every year. So if we calculate it in terms of dollars, it will be this, that is the value of investment multiplied by 11.7%. So this is what we are paying in terms of dollars. That's a dollar value. So to equity holders, we are paying annually $19,851.66. To our preference shareholders, we are paying 8.06% of the amount they have invested, which is equal to 3,100. And in dollars, it's 250. Is it 250? Yes, it's 250. To these ones, we are paying 4.9%, and to these ones, we are paying 5.53% annually. And the total that we are paying is $208,14.82 against the total investment value of 186,014. So if we need to calculate WACC, we have to divide what we are paying in total against the total value of the investment, and that's the WACC. Just convert it into percentage, 11.19%. Is it clear? So 1 to 5. Okay, thank you so much. Okay, let's move to part B now, and it's a discussion, right? Discuss the circumstances under which it is appropriate to use current WACC of TUFA company in appraising an investment project. Ashar, just remember the concept. Just learn the concept. You don't have to remember anything. Which one? Bank loan. There is no formula for bank loan. That's just I picked up from the question. So discuss the circumstances under which it is appropriate to use the current WACC of TUFA company. Now, I calculated this current weighted average cost of capital of the TUFA company, right? 11.99%. It says that in what circumstances TUFA company can use this 11.619% for appraising any project, that is calculating NPV with the help of this. Now, whenever you get at this question, remember the assumptions that we have. Let me ask you people a question. If the company is considering a new project for investment purpose, will that new investment require further capital or not? Right? Okay, okay. You know that the current source of finance, there are four sources of finance for the company currently, and they are in this ratio. Do you really think that the new project will be financed through all these four sources and in the same proportion as the existing ones? Usually not. You will either have to raise funds through issuing shares, obtaining bank loan, or issuing preference shares or loan notes. Usually, either of these, or it may be altogether something different. It may be a convertible loan note. So, if you are going for a new investment project and obtaining a totally different source of finance with a different cost of capital, what will happen? Will you still have the same WACC? WACC will change. Very good. But if I still want to use this WACC, what do I have to assume? What do I have to assume? I have to assume that the capital structure of the company, this is the capital structure of the company, these ratios, the capital structure of the company will not change, and the new project will be financed using the same sources of finances and in the same proportion as the current ones. That should be our assumption. So the circumstances that they are talking about, the one of the circumstances that they are talking about is the same, that we will be assuming that the new project will not change the capital structure of the company. This is the first assumption that we usually use when we use WACC for appraising projects, right? The second one, tell me, you know that we calculate cost of equity by assuming a certain level of business risk, right? We assume a certain level of business risk, and then we calculate cost of equity that our investors will expect this much return against this much risk. If the new project has a different risk level, do you people think that it will have the same cost of equity? No. And if the cost of equity will change, won't it change the WACC? Right? But if we still want to use the same WACC, what we should be assuming? What should our assumption be if we want to use the same WACC in this case? We will assume that the business risk will not change. So circumstances are no change to capital structure, that is the new business will be undertaken using the same source of finance, and hence no change to financial risk. No change to business risk, that is the business risk of the new investment will be the same as the existing risk of company. These are the two circumstances that we have to assume in case of using the same or current working WACC of TUFA company. I hope it's clear. Is it clear? The last question. Discuss 3 advantages of TUFA company using convertible loan notes as source of long-term finance. What do you people think? What are the 3 benefits of using convertible loan notes? The first benefit is it will be easy for the company to arrange finance for convertible loan notes than straight debt. More people will be interested to invest through convertible loan notes. That's the first benefit. The second benefit is because the company will be offering conversion option, it will be paying lower level of interest. That's the second advantage. And the third advantage is that it may not have to pay cash in the future, and it may issue shares instead of paying cash. That's the third benefit that it is going to receive. The disadvantage is that in the future, these people may become your partners and it will dilute your voting power. The first advantage was that by giving the conversion option, you will have more people interested in buying these convertible debentures or convertible loan notes, as many people will be interested to get this conversion option. Yes, you just need to explain each of these three advantages in 2 or 3 lines or 2 lines, and you will easily get these 6 marks. Hamza and everybody, just listen carefully. I just need to ask you people a simple question, just quick answer to this, right? If someone takes 1 hour to clean your room, right? And there is someone who just takes 15 minutes to fix your split AC. There's a problem in your split AC. You call somebody, you call an electrician, and he fixes that problem in just 15 minutes. And there's a person who cleans your room and takes 1 hour. What do you think? Whom will you pay more? Right? What will be the usual comparison? I don't think cleaning room is so technical work, but fixing a problem with the AC will usually be a technical work. So in that case, you don't look at who worked for more hours, who worked for long hours. You look at the technical work. In the same way, in an exam question, sometimes the marks will be available for the technicality involved in the question, and the other time there may be the length of the answer for which you will be given the marks. So let's move forward now and let's go to our next question. And I'm just giving you some time to solve this question, though it's not highly technical, but still it's a very good question. All you have to do is, it says that the company wants to expand, and for this expansion, which is going to increase the company's sales revenue, the company has two sources of finance. One is it may raise finance by issuing loan notes, and the other option is a right issue of $4 per share. Now you have to calculate or evaluate the impact of each of these two options on the financial gearing of the company, that is the gearing ratio of the company, the operational gearing of the company, the interest coverage, and the earning per share of the company, using both options separately. Let me write the formulas for each of these four in case you don't know. Financial gearing will be equal to your long-term debts, including preference shares, divided by sum of your long-term debts, including preference shares, plus equity. That's financial gearing. And operational gearing, which shows business risk, the formula of operational gearing is contribution divided by profit before interest and tax. These are the two formulas. And for interest coverage, it's PBIT divided by interest, and EPS is profit after tax divided by ordinary shares. So you have these handouts in Google Classroom, and if you want to take screenshot of it, let me increase the size so that you can get it, the clearer version. Just take the screenshot of this question, and I'll just drag it down so that you can take the another parts screenshot as well. Collie, we can use this fixed cost divided by total cost as well as our operational gearing. And when I'll be solving, I'll be telling you what operational gearing is, and then you will understand there is no difference between using the formula that I have given and the one that you are mentioning. They both show the same thing. Yes, just part B. So part A, not part B. Solve part A. I hope you have taken the screenshot of the first part and now take the screenshot of the second part. Okay, I hope you have taken the screenshot. So I'm giving you people 10 minutes. It's 9:49 here, and you have time till 10 p.m. Right? It's 10 p.m. Pakistan time. It may be some other time at your end. So it's a 10 minutes question. Try it, and then I'll be back. So back guys, let's do it, and I hope you people have tried this question. Now, a very important thing that you should note is whenever you are evaluating and you are comparing something, you have to have a comparative analysis and you have to calculate things before the change and after the change. So first of all, since we have the current situation given in the question, the income statement and the statement of financial position. So first let's calculate what the financial statement will look like in 1 year's time using both the options. So the first option is equity and the other is debt. So sales, what will be the change in sales? How much will be the change in sales? 12% increase. So the sales figure currently is 50,000 into 1.12. So it's going to be 56,000. Now we choose either of the two options, it will be the same. So no change to the sales figure because customers won't mind how you finance your investments. The same will be the case here. Okay, now let's calculate variable cost first. For some reason, so the cost of sale, the total cost of sale is 30,000, and how much of this 30,000 is variable cost? Is it 85%? Okay, yes, it's 85%, right? Right? Okay, if the current variable cost is 25,500 and your sales is growing by, your sales are growing by 12%, then your variable cost will also grow by 12%. So it will be multiplied by 1.12, 28560. And again, there will be no change because of the source of finance. So it will be the same. Let's calculate contribution. Then let's subtract fixed cost, and I'll be taking both fixed costs together, the administration cost and the fixed cost related to cost of sales. So the fixed cost related to the cost of sale will be 15% of 30,000 plus the administration cost, which is currently given, which is 14,000, and plus there is a change in the fixed cost, right? 5% change in the fixed cost as well of fixed cost, and that's the administration cost. The change is in the administration cost, so let's multiply it by 1.05. It's 19,200, and it will be the same here as well. Then we have PBIT. No, it's the expansion. And expansion means that you have increased the sales volume, not the sales price. And when the sales volume increases by 12%, it will definitely increase your variable cost as well. Anusha question said that the cost of sale, the variable cost of sale is 85%. So if the variable cost of sale is 85%, then definitely the fixed cost of sale will be 15%. So that's PBIT. Now comes the interest payment. In the with the equity finance, will there be any change to our existing interest cost? So it should be 300. But with the debt finance, there will be an increase to our interest cost, and we are getting a 10% loan note, right? And how much are they planning to raise? How much are they planning to raise? It's 5 million. So, and the interest is 10%. So the new finance is 5 million and the interest rate is 10%. That's for the new one, and the existing one will stay to be the same, 300. So it's going to be 800. So PBT, profit before tax. After PBT, we have profit after, sorry, we have tax, which is 30%. Rakib, contribution is just the difference between sales and variable cost. What do you want me to explain? It's just the difference of these two. Profit after tax will be PBT minus tax, that's PAT. Then comes dividend. How much dividend is the company paying? Do we have any dividend payout ratio? Yes, it's 60%. So the dividend payout ratio is 60%. 60% of the profit. Yes, it's correct. What's wrong with the fixed cost? It includes both fixed cost of sale and administration costs. And the retained profits will be interest is 10% of the new loan and 300 the existing one. The variable cost of sale is simply 85%. Existing one, I'm talking about the existing one. The existing one is 85% of the existing cost of sale. So if I take this, it will give me the existing cost of sale. Since sales are increasing by 12% next year, so it will also increase your variable cost by 12%. So that's retained profits. Fixed cost 15%, that the cost of sale, fixed cost of sale, which is 30,000, 15% of 30,000. And administration cost, existing administration cost is 14,000, and the question says it will increase by 5%. Okay, now so do we have opening retained earnings? Yes, we have last year's retained profit of 20060, right? So if we pick up this opening retained earning figure of 20060 in both cases, and the retained earnings ending balance will be this plus this. That's it. And the share capital will be, in the equity case, it is going to increase. So the share capital that previously was at 2500 level will now be increased by 5 million, 5,000, right? It includes the premium as well. Share capital and reserves, I should write better. And in this case, there will be no increase to the share capital and reserves. It will be still 2500 because that's a debt finance. So the total equity will now be retained earnings, closing retained earnings, plus your share capital and reserves. That's your total. And the long-term debts will be the same in case of equity finance, and that is 2500. But in this case, it will increase by 5,000. It will be 7,005. So total capital employed will be equal to equity plus long-term debts, equity plus long-term debts. Now it will be easy for us to calculate all those ratios and see the impact, right? So first of all, we have to see financial gearing. That shows us how much debts do we have as compared to our total investment. So what are the long-term debts? 2500, right? We have 2500 of long-term debts compared with our total capital employed. So the gearing ratio will be 7.74% in this case and 23.33% in this case. Because in the second option, we are acquiring new capital through finance, through debt finance. Rabia, in the second option, we are getting this new finance through through debt finance, right? So it is going to increase our long-term debts. That's 5 million. This 5 million will either be raised through equity or it will be either raised through debt finance. So if we raise it to debt finance, definitely it is going to increase our long-term debts by $5,000 or 5 million. So is that gearing ratio okay? Did you people get it? I haven't calculated return on capital employed. That's a capital employed, not return on capital employed. This is capital employed, not return on capital employed, and it is equal to total equity and plus long-term debts. So financial gearing of the company in case of equity finance will be 7.74%, and in case of debt finance will be 23.33%. This shows the business financial risk of the company. So the financial risk of the business will grow, will increase with debt finance. But the question is this acceptable level of financial risk or not? We don't know. But the financial risk is increasing. That's for sure. Because of comparison, evaluation, because of two options being there. Now comes operating gearing, operational gearing, which shows your business risk. And business risk usually arises because of fixed costs. Because if your goes sales volume goes down, it will also reduce your variable cost as well. But your fixed cost will stay the same, and we may have a chance of incurring a loss. So business risk is usually because of fixed costs. That's why the formula is contribution divided by PBIT, because the difference between contribution PBIT is the fixed cost. So if this ratio is higher, it means the gap between contribution and PBIT is higher. And if the gap between these two figures is higher, it means your fixed costs are higher. And if fixed costs are higher, it means you have a high business risk. So the contribution was 27440 and the PBIT was 8240. So the operational gearing in case of equity finance is 3.33, and which will not change with the source of capital. If you choose any source of capital, it will only affect your financial risk. Business risk has nothing to do with your capital structure. It has purely to do with your operating costs. A higher fixed cost will mean you have a higher business risk. A low fixed cost will mean that you have a low business risk. So the source of finance will never change your business risk. Remember this thing. So you may get a question where you may have to explain the difference between the two. Okay, then we have interest coverage. Interest cover, which is equal to PBIT divided by interest, just to know how many times of profit do we have to cover our interest. So we have to pay a $300 interest. We have $8240 of profits. So how many times profit do we have against our interest payment? It's 27.46 times, quite high. And we have 10.3 times in case we go for debt finance, still very high. Still very high. A 3 to 4 times interest cover is usually considered a good one. So it's still 10.3. Then now comes EPS, profit after tax, which is 5,558, and the number of shares in case of equity finance will increase. How many shares will be in issue if we go through equity finance? What are the existing number of shares? What is the existing number of shares in issue? How many shares do we have? What's the par value of the share? Yeah, here we go. The par value of share is 25 cents and we have total par value of 2500. So we need to divide 2500 by 0.25. So the total number of shares will be 10,000. So let me do it for you so that the examiner knows how we have calculated this figure. 2500 divided by 0.25. Okay. And we have to add the new capital in it. The new capital was $5,000 and the issue price was, what was the issue price? So we were to raise $5,000 at a price of 4. So divide it by 4 to find out the total number of new shares. So now we are dividing our profit after tax by the total number of shares in issue after choosing the equity finance. So the earning per share will be 0.49404. And if we want to convert it into dollars, we can also convert it into cents, but no need to do it. In this case, the profit after tax figure is 5208 and the number of shares will not change. It will still be 10,000. So no need to change. 0.5208. So that's how we will do the calculation part, but that's not it. There is evaluation and comment as well. So we have to evaluate and comment. EPS is simply the profit after tax divided by total number of ordinary shares. The existing number of ordinary shares were 2500 divided by 0.25. Total par value divided by par value per share to get the total number of shares. The new shares were issued at $4 per share and the total amount to be raised was 5 million. So 5 million should be divided by 4 to get the new number of shares. So how are we going to evaluate this? Will this debt finance increase the gearing ratio or not? Tell me, will will moving from equity finance to debt finance, will this increase the financial risk of the company? Yes. So with the debt finance, the financial risk of the company will increase. That's for sure. Now, how we are going to comment on this impact? First of all, what you have to do is you have to put headings for your discussions, like financial gearing. Excuse me. So the style of writing should be, first you need to explain what will happen to the financial gearing if we choose debt finance instead of equity finance. So we will simply say if we choose debt finance over equity finance, our gearing ratio, financial gearing ratio, So it's going to increase from 7.74 to 23.33%. But whether the 23.33% risk level is acceptable or not, that depends on management attitude, right? Then you have to talk about the operational gearing, and it will be very simple. You should state that there is no increase in the operating gearing of the company because of the two options. And it should always be the case, because operational gearing does not change with the change in any financing option. Well, we can discuss the existing position of the company, but I feel it's not required in this case, because it's not asking about the evaluation of expansion, or is it? It's not asking about the expansion, it's talking about the financing proposals. So my personal opinion is that it's better to just discuss and compare equity finance with debt finance rather than discussing the existing position. But if you want to discuss it, it's okay. Now, after financial gearing, you can simply say that operational gearing will not change with any option of finance. Therefore, it stays the same in this company case as well. The interest coverage has reduced from 27.103 times because of the financing option. But again, whether this 10 times is enough or not, that depends on the management. But usually 10 times will be considered as a good one. So the company can go for the debt finance even if it is going down to 10.3 times, because it's still very good. Now, the EPS, the earning per share of the company investors is increasing, and it will be a good indicator for the investors. Therefore, if you look at the overall impact of financing option, it seems favorable. Therefore, the company may go for financing this new expansion through debt finance. That's what we should be writing and discussing. Is this clear? Okay, thank you. So, should we have a break? Okay, so let's take a 15 minutes break, because then we won't have any break and we will continue till the end of the session. Well, the conclusion should be there, but maybe we don't have to give recommendation. But conclusion and recommendations are two different things, right? Conclusion means just conclude whatever you have said so far, whereas recommendation means that end up by recommending a particular option. So I'm back, guys, and I hope you all are with me. So let's now start business valuation. Well, what is business valuation? Let's quickly have a recap of business valuation and then we'll straight jump into the question. Business valuation is when you set a value for your business. Like, for example, if you are willing to sell your business to someone, there has to be a price at which you will be selling this business. The process through which you find out the value of your business is called business valuation. You might want to sell the shares of your company, especially if it's a private company or unlisted company. You need to find out the value of each of your shares so that you can sell it to someone. You might be willing to get listed in the stock market, for which you need to value your company. You may be merging with any other business, and you may be willing to find out the overall value of the two companies after getting merged. So there are different reasons why we will be finding out the value of a company, but the process is called business valuation. So without going further into this detail, let's jump into this question, Forbes company question. Calculate the value of Denoka company using the following methods: price slash earning ratio method, dividend growth model, and discuss the significance to Forbes company of the values you have calculated in comparison to the current market value of Denoka company. So let's start solving it. Forbes company is considering a bid for Denoka company, and both companies are stock market listed and are in the same business sector. And financial information for Denoka company, which is shortly to pay its annual dividend, is as follows. Now, it's a very interesting question. Forbes is considering a bid for Denoka company, so definitely it will be looking to value the value of the Denoka company, value Denoka company. Since they both are listed companies, so it means that Denoka company will already have a price, stock market price. But still, why we need to find out the value of the company if we already have the price in the market? That's a very interesting scenario. And once we will be discussing it, we will discuss this part as well. But let's first now do some calculations. Calculate the value of the Denoka company using the following methods. One method is the price earning method, and the other is the dividend growth method. But before I start with the question, let me first explain what's the price earning method. Just look at this example. Let's say there is a company A. This company, let's say, earns $5,000 every year, right? And investors are willing to buy this company for $25,000. So it means that's the price of this company, and this is the earning of this company. This is the per year earning of this company, and this is the price of the company, right? So the investor is willing to buy this company for $25,000, knowing that each year it is going to earn 5,000. So it is valuing the company as 5 times of its earning, or you can say it is valuing the company equal to 5 times of its 5 years of its earning. The price earning ratio of this company is 25,000 divided by 5,000. That's 5 times. This is called PE ratio. This company is valued as 5 times of its earning, which means that if it is giving us an earning of $1, we are willing to pay $5 for this share, which is giving us $1 of earning on every share. That's what price earning ratio is. So we have to use this ratio to find out the value of Denoka company. So that's A1 using value using PE ratio. So first of all, we need earning per share of, which we call EPS, of Denoka company. What is the EPS of Denoka company? It's 40 cents. The EPS is 40 cents. Okay. Price earning ratio now. Now, remember one thing. To value a particular company using price earning ratio, obviously we cannot use the same company's price earning ratio. We have to pick up a similar size company, or we may pick up the industry average. So we have to pick a similar company and we have to pick the PE ratio of that similar company, or we may have the average PE ratio of this sector or industry and use it for valuing the company. So in this case, we have the average sector price earning ratio of 10 times. That is the business sector in which these companies are operating. Their investors value the company at 10 times of its earning. So they are ready to pay 10 times price compared with the earning. So the earning of the of the Denoka company is 40 cents. The average PE ratio of the sector is 10 times. So the market price per share using PE ratio will be equal to 10 times of the earning per share, 40 into 10. But the answer will be in cents, but it's better that we should write it in dollars. So let me divide it by 100 to get it into dollars, and you can say it's $4 per share. But that's not the total value of the company, that's the per share value using the price earning ratio. And now let's calculate the total value by multiplying the PE ratio, by multiplying the price by the total number of ordinary shares, which is 5 million. So let me multiply it with 5 million. So the answer is in millions. We can say it's $20 million. So according to PE ratio, this company has a total value of $20 million. Now we have another way of calculating the value, that is using growth model, dividend growth model. Dividend growth model can be used for calculating both cost of equity and price of the company. A slight adjustment is required. The original formula, or you can say that the formula for cost of equity using the DGM model was D naught into 1 plus G divided by X diff price, and then we should add the growth. So if we reverse this formula, for calculating the market price per share, it will be D naught, that's the dividend of year 0, into 1 plus G, the growth, and this should be whole divided by KE minus growth. That's where when we calculate market price per share. So what's the current dividend per share? The current dividend. Has they given us any dividend? In the top line, they said that Dinovka company is shortly to pay its annual dividend. So it means that it hasn't paid its dividend yet. We have a dividend of 1 year ago and 2 years ago. That's not what we need. We need a current dividend first. So we don't have the current dividend figure, but we have the current earning per share and the payout ratio, which is 60%. So we can say the current dividend will be 60% of the earning per share, which is 40 cents. So it's 24 cents. That's going to be the dividend which the company will be paying, 24 cents. So let me show you again so that you people don't ask me again, because it takes so much time. So dividend payout ratio is 60% and the earning per share, the earning of the company is 40 cents. So the per share dividend will be 24. So, and do we have a growth? We don't have a growth rate, so we have to calculate the growth rate. So a dividend of latest dividend, the latest dividend is 24 cents. What's the earliest dividend? Which one is the earliest dividend? 22 cents, yeah, and that was paid 2 years ago. 22 cents. And now we have to find out the growth between these two. So I told you, to find out the growth, all we have to do is to divide the latest dividend by the earliest dividend and take the power 1 upon n. What's the number of years? What will be the number of years? 2 years, not 3. It was 2 years. It was paid 2 years ago. So 1 upon 2 minus 1, and then we should multiply it by 100 to get the percentage. And it's 4.45%. The growth rate is 4.4%. So let's now calculate. Okay, we also need cost of equity, right? Sorry, cost of equity, yeah. Right now, let me tell you something important which you need to note down anywhere on your registers. I want you people to have pen or whatever you are using for noting down, because this is another one. This is the another small mistake that students make. When you know that when you are valuing a company, you will usually have two companies. One is the company that is acquiring another company, and the other company is the target company. We have a Forbes company here, and we also have a Denoka company. Which of the company is a target company? Which of the companies is a target company? Denoka company, right? Right, now note it down. We should always use cost of equity of target company while using DGM for valuing the company. The cost of equity should always be of the target company when we are calculating the value of company. It should always be of the target company. So let's calculate the cost of equity of Denoka company. Let me mention it. And it's going to be calculated using the CAPM model, right? So the risk-free return is 4.6%, plus the equity beta is 1.4 times. The market return is 10.6%, minus the risk-free return, which is 4.6%. Shahryar, I just said that while using DGM, dividend growth model, for valuing company, we must always take cost of equity of the target company. That is the company for which we need to find out the value. It's 13%. Now we have found everything that we need for dividend growth model. We have the latest dividend, which is 40 cents. We have the growth rate, that is 4.45%, and we have cost of equity, which is 13%. From the cost of equity, we need to subtract cost of growth, and market price per share, and that's in cents, whereas we need it in dollars. So let's put bracket around this figure and divide it by 100. So it's 4.88 per share, and the total value will be 4.88 multiplied by 5 million. So according to the dividend growth model, the value of the company is 24.42 million, higher than the value calculated using the PE ratio. So the calculation part is now over, but there is another important part, and that is the discussion related to the significance to Forbes company of the values you have calculated in comparison to the current market value of the Denoka company. What's the current market value of the Denoka company? What's the current price of the Denoka company? It's 3.3. So current value 3.3 into 5 million. So it's 16.5 million, right? Is it 2.93? Okay, let me calculate it again. Okay, let us calculate again. Let us calculate again. That's not a big deal. The current dividend is 24 cents into 1 plus growth, which is 4.5%. Then that's divided by K minus G. Okay, yeah. Yep. And yeah. So it's 14.65 million using the dividend growth model, and the current value is $16.5 million. Right now, it says that discuss the significance of these values too for Forbes company. Now, remember now I'm going to discuss a very important aspect of these values. So just focus. In the stock market, the current price is $3.3, and the total value according to the price in the market is 16.5 million. But the the owners that have controlling interest in Denocom company, they will never sell this company for this price, and there's a reason. When you go to the market and you find a share of $3.3 for a particular company, that is always without the control of the company. You will get shares at a rate of 3.3 but very few shares, you can't get 51% shares at the same price from the market, because with 51% you will get the control of the company as well. You will become the you will get the controlling interest of the company. So you won't be able to get this controlling interest for the same price. So when the company is in, when those who have the controlling interest in the company, they will always sell the company at a higher price than the market price of the company, and that the reason is the control. So forget about getting this company at this price. So we can discuss this impact that the current market price is $3.3, and probably the Forbes company cannot quote this price because this is the open market price where shares are being sold without controlling interest. So with the controlling interest, the share prices will definitely be higher. Now, why the dividend growth model has predicted a lower value than the current value? Who's going to tell me? Why has the dividend growth model predicted a lower value than the current market value? What's wrong with the dividend growth model? Do you people have answer to this question? Why has the dividend growth model predicted lower market value for this company than its market value? Okay, let me explain and listen carefully. This may be asked in the question. That's a concept. We have just 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 look at here. What growth rate have we used in the dividend growth model? What growth rate have we used in the dividend growth model? 4.45%, right? 4.45%. Yeah. And that growth rate was for the past dividends, and that even for only 2 years. We just picked up 2 years and used the historic growth rate for predicting the price of the company. So we think that the shareholders will be satisfied, or they will expect 4.45% growth in the future, but in practice the shareholders are expecting a higher excuse me, growth in dividends. That's why they are valuing the share at a higher price. Right? So one of the reasons why the existing price of the share is higher than the growth model share price, and that the reason is the growth rate. Maybe the investors in the market, they expect a higher growth rate than we have used in the dividend growth model. Because when you expect a higher growth rate from any investment, you will value it higher. Let me give you a very simple example. If you have to buy a building, and you want this building to be rented out to someone, Will you value the house more if you expect more rent in the future? There are two buildings of similar nature. Everything is same. The locality, the design, everything is same. But one of the houses is rented at a higher value and the other house has been rented at a lower value. Which house you will buy at a higher price? The one having the higher rent or the one having the lower rent? The higher rent. Obviously, if you are getting a higher rent from a building, you will place a higher value on that building. It's a very simple formula. The more return you expect from a share, the higher price you will be willing to pay for that. So if the investors in the market is willing to pay a higher price than the price predicted by the dividend value growth model, it is very obvious that they may be expecting a higher return, higher growth rate than the growth rate put into the growth model. That's why they are valuing the share at a higher price. So one of the reasons is the growth rate difference. Okay. The other reason might be the cost of equity. The other reason might be the cost of equity. Let me go to the question and let me increase the cost of equity. Instead of writing 13%, let me write it as 18% and see whether it results in a higher price or lower price if I increase the cost of equity. Has it resulted in a higher price or lower price? Lower price, right? And let me reduce the cost of equity. Let me reduce the cost of equity and let's reduce it to 10%. See, now the price has gone up. So if the price that is actually prevailing in the market is $3.3 and the price predicted by the growth model is 2.93, the other reason might be that the investors expected return is less than the return we have put into our formula. They may be expecting a lower cost of equity, return on equity. That's why they are ready to pay it at a higher price. So there are two reasons why dividend growth model might be predicting a lower value than the actual value. One is the growth rate and the other is the cost of equity. These are the two reasons why growth model will usually report a lower or higher value than the actual market value prevailing in the market. So remember these two things. So now let's end it. Let's end the discussion. Do you really think that the Denoka company will be selling the company for $20 million? It may be willing to sell it for $20. It may be because it's higher than the current stock market value. So it may be. this may be the value. So that's value, that this value has a significance for this company. Will this be a value for Forbes company? Should Forbes company expect the Denoka company to be selling it for 14.65 million? No. So it has a low significance. Will this be considered? Yes, this must be considered. This should be the minimum. The Denoka company will consider this and they will accept any price above this. This will be their threshold value below which they can't even think of selling the company. So that's the Forbes company. So I urge you people to go through this question again. This is the past exam question. You should go through this question again at home and think about it. We are done with the today's session. Tomorrow we will be discussing risk management, the last area of our syllabus. And we will also be discussing the paper pattern tomorrow. And then tomorrow I'll be wishing you best of luck for your papers. And I hope these days, these sessions has added some value to your preparation. I hope. Because of the time constraint, I just had only 15 hours at my disposal, and I've tried my level best to focus on most important areas in which most of the students they make mistakes. I know I haven't gone into very much detail, but I have tried to focus on those tiny things in which most of the students they make mistakes. So it has been 4 days since we have been together. Now I would like you people to give me a rating from 1 to 10 for the overall experience that you people had. But be honest with your rating. Uh, a lower rating will usually help me improve if it is um, given, but be honest with your rating. I want to know the honest rating from 1 to 5, 1 to 10. Collie, you have always been a very strict teacher, but thank you very much for being honest with your opinion. What is 23.3, Mohammed Hussain? I have explained the theoretical part. Whenever I was explaining the concept of something, that was a theoretical part. I could not write the whole solutions because it will take some time, but whatever I've explained, whatever rationale I have explained, whatever concept I have explained during this, that was the theoretical part. Thank you, Sanket. Thank you so much. Well, my support to all of you will be available on the WhatsApp group. I have allowed you people to ask me questions on the WhatsApp group, and I will respond to your WhatsApp group, though I was not able to respond to your individual messages. Imagine I have more than 200 students, and around 180 students are in the group, and there were many students who were texting me in private, so I could not reply to everyone. But on the group, I will try my level best to reply. So that's it for today. Uh, Tomorrow we will be discussing risk management, and since there are students who are asking for more practice on business valuation, rather than I should add more questions, I will request you people to go through few questions yourself, and if you find any problem in any question in from anywhere in the syllabus, just send me that question on the group and I will respond to that. Thank you so much, and see you all tomorrow at the same time. Bye and have a good day. Thank you so much, Maham. Thank you so much. I'm really, really honored. Thank you.